Welcome to the Jailbreak Your Retirement to Invest in Real Estate and Other Alternative Assets webinar. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Our presenter today is Brad Sininsky, and I briefly want to introduce Brad. He is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing, and Brad is also a licensed California real estate agent with a passion that lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you for joining us today, Brad, and I'll let you take it from here.
All right. Yes. Thank you, Leah. Appreciate the intro. Thank you, everybody. Please, as a reminder, type in your questions as we go so you don't forget them. I may answer them throughout. I may not. But either way, we'll circle back through all of them at the end. We'll give plenty of time for that. So, yes, we're going to talk about how to jailbreak your retirement to invest in just about whatever you want. First of all, Sense Financial is not a fiduciary. We don't provide legal, tax, investment, accounting, or other professional advice. If you need such advice, please reach out to that competent professional. And then our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And that is indeed true. You work hard for your money, and we want to come alongside you and work hard for you on what we do in this capacity of helping you have control over your retirement account and unlocking it. And so let's talk about exactly that. First off, why should you listen to us? Well, we have clients all over the place. We service all 50 states. We have 5-star reviews. We have about 3,500 clients, and we've been in business since 2010, so way past the startup phase. Systems are in place, and you can check those testimonials on BiggerPockets, Google, Yelp, and elsewhere, Better Business Bureau, to see for yourself what our clients are saying about us. So encourage you to do that, especially if you're shopping around and looking at considering different companies that may offer similar services. Definitely encourage you to check out the reviews before making your final decision. First off, let's talk about the conventional versus the self-directed retirement. So these are your basic options when it comes to a retirement plan. You can invest in the conventional side of things, which is that bus that stays on the track, and you have to get to the stop at a certain point, get picked up at the drop-off, and walk to your destination. And that's your conventional side. That's your 401k at work. That's your conventional IRA with Vanguard, Fidelity, Schwab, whoever, invested in stocks, bonds, mutual funds, and ETFs, more recently ETFs. And on the other side of things, you have your off-road vehicle. This vehicle can go anywhere, through water. It can go where the bus goes, but it can also go where the bus can't go. And so that's your self-directed side. In some ways, it is the Wild West because the IRS does not tell you what you can invest in. That would be impossible to exhaust that list. Rather, they only tell you what you cannot invest in. And that's essentially collectibles and life insurance. We'll talk more about that in a few slides from now. But we're going to focus more on the right side there, on the self-directed side, not because there's anything wrong with the conventional side, but because that's what we specialize in. We specialize in giving you control over your retirement account to invest in the conventional side as well as the self-directed side. But let's be real. Our clients are not coming to us to invest in Wall Street, in stocks, bonds, mutual funds. They're coming to us to invest in alternative assets. And so that's what we're going to focus on, which literally, as I was saying, is just about unlimited investment options. Some common examples: private lending, precious metals, Bitcoin or other cryptocurrencies, residential real estate, commercial real estate, tax deeds. You can invest in mortgages, private equity. You can invest in businesses, private businesses. And so almost the sky's the limit, but those are some more common examples. And a real life example of Brad and Jennifer here, they are solo 401k clients of ours. and have been for a while. But when Brad first came to us, he wanted diversification. In fact, he was and still is a real estate agent alongside his wife, and they want to run a business together, primarily helping buyers and sellers sell or buy the place they call home. But they also work with investors, and so he had a desire to invest in real estate, not just personally, but also inside of his retirement account. And so we created a solo 401k for him, which has a traditional component to it, pre-tax, as well as a Roth component. And so Brad wasn't stupid. He saw the writing on the wall. He wanted as many tax-free ATM withdrawals as possible at retirement. And so he wanted to build up his Roth as much as possible. So they have millions of dollars in real estate in their Roth solo 401k. It's actually a really cool story, both commercial and multifamily multifamily real estate. So we offer two options: the self-directed IRA, which is for just about anybody, as you can see by the diverse crowd in that picture, and then the solo 401k, which is primarily for the business owner and their spouse. And we'll dig a little more into both of these as we go. But that, just to give you an idea of the two products we offer. And so we call it a checkbook IRA. So there's a couple different types of self-directed IRAs. You've probably heard of a self-directed IRA, and maybe you know how it works, maybe you don't. But there's essentially two kinds. There's what's just simply called a self-directed IRA, where there is always a custodian, by the way. No matter what kind of IRA you have, per IRS law and guidelines, there has to be a custodian. But in the self-directed IRA, you actually have to go through the custodian for all transactions. Okay. So if you see a property you want to buy, you have to contact the custodian and say, here's the address, here's the purchase agreement, please sign it, initial it for benefit of my IRA, right? The custodian is on title for everything, all assets, all accounts, and you have to go through them for all transactions, which can cause delays, red tape. It can also cause some transaction fees, depending on the fee schedule of the company. Could be an annual fee that kind of covers all, but more often it's quarterly, or it's an each transaction type fee. Okay, and then enter the world of the checkbook IRA, which is the only type of IRAs that we do at our checkbook IRA. And so there's still a custodian. Let me show you the diagram. When you say, I'm ready to go, the first thing we will do is we'll open a new account with an IRS approved custodian. Now, this isn't just any custodian. This is a custodian that allows for non-Wall Street investing, alternative assets, right? And they also you can do Wall Street as well. I'll talk more about that. But again, most of our clients are not looking to do that. Now, once that's done, a transfer will be set up. And the reason there's a transfer, there doesn't have to be. You could start out from zero, but the annual contribution limits, 7,000 under 50, 8,000 over 50, are generally not high enough to start out from zero with a self-directed IRA and invest in alternative assets. Now, don't misunderstand me. You could take $500 and put it in an IRA and invest it in Bitcoin. I mean, you could do something like that. Most of our clients are looking for real estate in some way, shape, or form. And so typically you need more than the $7,000 or $8,000 that you could technically start out with from a contribution perspective. So 99% of the clients that we bring in for a self-directed IRA actually have existing retirement funds that they're going to roll into that IRA. Hence the term jailbreak, like we were talking about in our title. So we jailbreak those funds so they can self-direct them. So this can be a current IRA, Roth or traditional, a 401k, Roth or traditional, 403b, Roth or traditional, as just a couple of examples of what can go into the self-directed IRA. This is a tax neutral event. It's not a taxable event, and that money will go in and you can self-direct it. Now, once that's set up, we also we create an LLC. So this is where the checkbook control comes in, the checkbook IRA. So this is not just any LLC like you might create for a holding company or running a business. This is a special purpose LLC. And essentially it is a holding company, but it's special purpose in the sense that its only member is not a human. It's not you. Its only member is actually the IRA. You are the manager of that LLC. So with that manager control, you can open up accounts like a bank account. So that qualified transfer that's currently pending while all this is going on will goes from custodian to custodian. So it'll go into a custodial checking account. And then shortly after that, once everything's set up, the custodian will transfer that money from the custodial account into the LLC bank account. That's at the point when all that's done, you're set up and you're ready to self-direct. Okay, so this checking account is opened up in the name of the LLC. You're the manager of the LLC. That's what gives you the ability to open up that checking account and also self-direct those funds that are now inside the LLC, of which the IRA is the only member. Okay, so once that's all set up, you can make investments. All the income and expenses must go into and come from that IRA. Outside of taking a distribution, you don't want to take any money out of the IRA. Okay, so that's how the checkbook IRA works. And so I just have one diagram on that. We can dig in on some questions if you guys have any, but essentially anybody can do a self-directed IRA. Okay, there's no self-employment requirement or anything like that tied to it. So what is a solo 401k? We're going to spend a little more time on this because there's a little more to it. But essentially, it's, as I mentioned earlier, it's for the business owner and their spouse. Forgive my odd-looking AI-created image couple here that were supposed to be home inspectors when I created this. But anyway, just an example, self-employed as home inspectors. The only employee in the business and still qualify for a solo 401k is a spouse. Okay, so Bible says you and your spouse shall become one flesh. You are, IRS sees it the same way. You who were two now become one. And so that's the only exception to the rules about employees, full-time W-2 employees. Okay, so the business owner and their spouse. And I'll talk more about partnerships and such here in a few minutes. But you do have to have that legitimate self-employment activity in order to qualify to sponsor a solo 401k. So here's the way it works. So you have this legitimate self-employment activity, meaning it's not passive income. It's actively earned business income. Okay, you could be filing a Schedule C, you could be a S corporation, LLC, partnership, multi-member LLC, sole proprietor. It all works. Okay, and incidentally, these are examples of the plan sponsor, right? The company that adopts the 401k plan, which is like if you worked at Walmart, Walmart has their own 401k plan. So Walmart is the plan sponsor that you as the employee would have an account in. It's the same thing with this, except it's not Walmart, it's your own business. Same exact idea. Incidentally, on the partnership or multi-member LLC situation, those partners or members of that company don't have to be spouses, okay? There just can't be any non-owner employees. So for example, this is just not yesterday, the day before, I had a consultation with somebody who had a multi-member LLC that was conducting hard money loans and flipping real estate. And it was him, his wife, and his two sons. Okay, and they're all owners. They're not all on payroll. He had it set up as a C corporation, but they're all members of this LLC. But because of that, they're all members and not employees. They can actually, that LLC could sponsor a 401k plan that all of them could take advantage of. Now, in order to make contributions, they have to have W-2 income because they're a corporation, they're a C corp. So without getting into the weeds on that, just to give you an idea of what it looks like when there's some non-spouses involved in business together. So anyway, plan sponsor adopts the plan. We create the trust in the plan, and you are the trustee of this trust. The solo 401k is a trust, okay? And you are the trustee, which gives you the checkbook control inside the solo 401k. So unlike the IRA, where there is still a custodian no matter what, there is no requirement for the 401k to have a custodian. So there is no custodian. It's eliminated. You are the plan administrator and you are the trustee, which gives you the ability to open accounts and make investments. And all assets are inside this solo 401k trust. Okay. So that's how that works, which gives you the ability to open bank accounts or an account at any financial institution, a brokerage. Like if you want to invest in Wall Street, for example, you can open a non-prototype, non-custodial brokerage account at Schwab, Edward Jones, Vanguard, wherever, and invest using the solo 401k funds inside of stocks, bonds, and mutual funds as well, or I should say, not inside. And so that's how that works. And then, of course, just like the IRA, all the income and expenses for investments come from and go back into the home for the funds, which is that bank account. So that's how that works. And by the way, when it comes to bank account, and I keep saying bank account, it's just think about a regular checking account. People get confused about this. It's just a regular checking account. We're going to recommend a certain bank because they're going to do it right and they're going to help you open the account without any pushback. And so you have a debit card, you have a checkbook if you order checks, online bill pay, wire transfer capability. You can order cashier's checks if you want to do like courthouse steps transactions, for example. So it's just a regular checking account. Just want to make that clear because when I'm doing consultations, people have some confusion around that. Okay, so the contribution limits, unlike the IRA, are almost 10 times, or literally 10 times, if you're under 50. So 7,000 IRA, 70,000 for solo 401k, or if you're over 50, 8,000 IRA, or 77,500 for solo 401k. Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. On the next slide, I'm going to break this down. But essentially, when you're self-employed, you wear two hats. Hence my image here. You're an employer, the business owner. You're also an employee of that business. So the IRS allows you to make two types of contributions, an employee contribution and an employer profit sharing contribution. So I'll break those down. So the employee contribution, AKA elective deferral, this is the same limit you have at all 401k plans. Okay, so if you only worked at Walmart, in my example, your limit is $23,500. If you work at Walmart and I don't know, McDonald's, and you have some self-employment income from selling real estate, your limit for all 401k plans is $23,500. This is if you're under 50. You cannot double dip on the employee contribution. It's all 401k plans. Now, if you're over 50, you get a $7,500 catch up on that. If you are if you turn in the years you turn 60, 61, 62, and 63, there's actually what's called a super catch up, which as part of Secure 2.0 just became effective this year, where your catch up contribution goes from 7,500 to 11,250. Don't ask me why 60 to 63, write your congressman. I have no idea, but that's the rules right now. Now, the employee deferral can be up to 100% of your self-employment earnings. The contributions must be made within 7 days of paying yourself. Now, this is if you are a corporation, you're running payroll, S Corp, C Corp. The contributions must be done through payroll. And they could be either pre-tax or after-tax Roth style contributions. So that's employee contributions. Employer contributions, AKA profit sharing, is always a tax-deferred contribution to begin with. It's up to 25% of your compensation if you're a corporation and you're running payroll. So if your W-2 is 100,000, you can put in up to 25,000 of that 100,000 in a profit sharing contribution. If you're sole proprietor, it's based on your net profit, or single member LLC, it's based on your net profit, and that's 20% of that profit. And again, it goes in as a tax-deferred contribution, but you can actually convert it similar to the way a backdoor Roth works. You convert it the next day or the same day to a Roth, and so it can become a Roth contribution. But it is a tax-deferred contribution. It's a business expense for the business. So when you do that Roth conversion on that, you're going to have to issue a 1099 to yourself as the plan administrator for that income for the Roth conversion. And then, so the total limit we talked about earlier, but I'll just break it down for 2025 is 70,000 per year. If you're under 50, 77,500 if you're over 50. And then again, between 60 and 63 during those years only, then you can do that 11,250 catch up instead of just 7,500. And then for 2024, because it's not too late, if you are considering this for 2024, then you can do 69,000, including the 7,500 catch up. Okay. All right. So the IRS as this is also as part of Secure 2.0, there's an auto contribution tax credit. You can ask more questions about it, or we can talk about it one-to-one off this call, but I don't want to belabor the point. The IRS will give you a $1,500 credit if we amend the plan to include that, and that's spread out over 3 years, $500 each year. There's an annual filing requirement that we help you with for the life of the plan, even after all those credits are done. So that never goes away, which is kind of a pain, but it's just something that's required. And so essentially, the establishment and then the annual fee and everything, and I'll talk about the fees on this in a little bit here, will cost you pretty much nothing for the first several years if you get the $1,500 tax credit. So, but it's optional. Incidentally, you cannot, the plans with a brokerage, like if you're thinking, okay, I can do a solo 401k anywhere, like at Vanguard, actually Vanguard won't do them anymore, at Fidelity, for example, you can do a solo 401k there. Of course, you're only going to be able to invest in stocks, bonds, mutual funds, and ETFs. So most of our clients are not looking for that, but they can't do things like amend the plan to include this auto contribution tax credit. You also wouldn't get a participant loan option. So just to give you a couple of reasons why you wouldn't want to necessarily go there and do it, even though it is an option. I think we talked pretty good about checkbook control. You can get a loan, IRA, 401k, to buy more real estate. It has to be non-recourse. And so this basically means you cannot provide a personal guarantee. So your income, your credit history, none of that is part of the factor. It's the property that is the only security. It's also the only thing that the lender can go after, and if in the event of a default, because it is a more risky loan, it does require more down, 30 to 50%, and the property must cash flow, of course, because it's the only thing that is securing the loan. And then you do need to have some reserves, and it will trigger a UDFI tax for an IRA, which is essentially a tax on the income. So the IRS says, okay, you can go get a mortgage for real estate in your IRA, but because you're not only using IRA money for that purchase, we are going to charge you a tax on the income that is generated from that real estate because of the loan. So if it's 50% mortgaged, 50% of the income is subject to this UDFI tax, which stands for unrelated debt finance income, which actually triggers a UBIT tax, which is unrelated business income tax. So just remember UBIT, UBIT, and so 50% of the income would be subject to this UBIT tax. If you guys want to talk about it, you can ask me questions, but I'm not going to get into it too much past that on this call unless somebody wants to. Now we do have some lender. Oh, incidentally, a solo 401k is exempt from that tax on real estate. Okay, so it's a great vehicle to buy real estate in. And then we do have a list of private lenders who will do non-recourse loans on our website, SenseFinancial.com /non-recourse-lenders. You can check that out. There's probably 7 or 8 different options. Okay, so I mentioned this earlier, disallowed investments, collectibles and life insurance. The collectibles thing is kind of it's somewhat open to interpretation, and the IRS has bigger fish to fry, so they haven't really weighed in on like super specifics of what collectibles are. Like I heard somebody the other day talking about a car, like a 1980 Porsche 911 that has some collectible value to it. Obviously, it's a collectible, and that's where the value is. So you couldn't use the retirement account to buy it and hold it and sell it later. And you can't store it. You can't do. Yeah, there's so many restrictions. But anyway, you couldn't do that because it's a collectible. But what if the retirement account was involved in like buying it and rehabbing it and selling it, similar to what you might do in a real estate flip, which is allowed? And that's a gray area. The IRS has not weighed in on something like that. The CPA attorney that I was listening to said they would not recommend pushing the envelope on that, that it's probably considered collectible. But think baseball cards, stamps, um, some precious metals. There's some that are allowed, of course, gold, palladium, silver, and I think one other is platinum, I believe. And they have to be certain grades of quality and such. But so those are allowed, and those are some exceptions that the IRS has weighed in on very specifically. But just if you have to ask the question, is this a collectible? It's probably a collectible, so I'd probably stay away from it. And then life insurance. There is a way to do some life insurance type investing in the solo 401k, but most of our clients are not looking to do that. But that is not allowed at all in the IRA. So the other thing, or people prohibited transaction, if you will, that could be generated is if you invest with a disqualified person. But it's more than that. When it comes to investing, just think arm's length. Okay. This is your immediate family, by the way. Okay. So you, your spouse, your parents, your grandparents, your children, their spouses. Okay. And your grandchildren. So the linear descents up and down. Okay. Vertical descents. Brother, sister, aunt, uncle, all that's cool. So just arm's length outside of those people that I mentioned. So if they own something like a business, you don't want to invest in that business with your retirement account. That would be a prohibited transaction. And there's certain percentages of ownership to get into, but just know that it's probably best to just stay away from that. Plus, investing with family is dangerous anyway. I don't know if you want to have those awkward Thanksgiving dinners. If something goes sideways, personally, I don't. So just stay away from it is my recommendation. And then the other piece to the disqualified parties is they can't personally benefit from anything that the retirement account owns. So if you owned if your IRA or 401k owns a piece of real estate in, call it Arizona, and your daughter's going to school in Arizona, she could not stay at that property. Okay. You can't go stay at that property. Your wife can't go stay at that property. Even if you pay full market value for it, it's an Airbnb short-term rental, and you're going to pay more than full fair market value. You still can't do that. That would be a prohibited transaction. Your brother can go stay there, but you can't. Okay. That's where the line is drawn. You also can't be compensated by the retirement account. So this actually comes into play with people who are handy, and they're used to tinkering, and they're used to unplugging toilets themselves, or unclogging, I guess would be the right way to say that, or plumbing or electrical or whatever. You can't go mow the lawn on a rental property that your retirement account owns. Okay. You can hire the person that mows the lawn or swings the hammer, but you can't do that job yourself. Okay. So that's, I think, you can do the blue collar work, but you can't do, excuse me, you can do the white collar work, but you can't do the blue collar work. Okay. That's the easiest way to say it. So now that that's done, let's just, here's just a quick graph you can take a screenshot of if you want, of the difference between the self-directed IRA, which again, we don't do. That's the one where you have to go through the custodian for everything. IRA LLC, AKA checkbook IRA, checkbook control, and then also the solo 401k, which of course also has checkbook control. And I forgot to update the limit. It's actually 77,500 for the solo 401k if you're over 50. Incidentally, let's talk about the personal loan. So the solo 401k has the option to take out a participant loan. Now this can be up to 50% or $50,000, whichever is less, and you can use that for virtually any purpose. We've had clients who have paid off high interest credit card debt doing that. We have one client now who I know of for sure, who is, I don't know if he still is, but about 6 months ago when he first started his solo 401k, he was using the participant loan option to fix and flip real estate in his flipping business to fund those flips. Now, that's also the sponsoring business of his solo 401k. Now, these are not flips that the 401k is doing. These are flips that his business is doing. And so the income from those flips can be part of the contribution amounts for the solo 401k. And he was just paying off the loan, the participant loan to the 401k, instead of getting like a hard money loan from somewhere else or as much of a hard money loan. He's paying his own retirement account back. And there's no prepayment penalties. It's a 5-year amortization. Payments need to be made either monthly or quarterly. It's up to you. If you use it for a primary residence purchase, then it can be a 15-year amortization period, still monthly or quarterly. Everything else is 5 years. Okay. So the other thing I want to talk about is the Roth. So an IRA is either a Roth IRA or it's a pre-tax IRA. It's not both. Any type of retirement account any qualified retirement account can go into a solo 401k with the exception of a Roth IRA. A Roth 401k can move into another 401k, a solo 401k, but not a Roth IRA. So if you have a Roth IRA that you want to self-direct, the only option is a Roth self-directed IRA. And then if you want to, but the solo 401k, unlike the IRA where it's either Roth or traditional, it's not both. The solo 401k has a Roth component and a traditional pre-tax component all built in. So it's the ideal vehicle for Roth conversions because you can, of course, convert cash or assets as well to Roth from traditional pre-tax. And when you do that, you actually can get a discount on that because the valuation can come in lower than the actual principal investment. So the solo 401k, if you're looking to do Roth conversions, is definitely the ideal vehicle for that. And of course, it does have the self-employment requirement attached to it. So we do have a free ebook that Dimitri, the founder of Sense Financial, wrote. It says IRA Makeover, but it talks about the 401k as well. And so you can grab that if you'd like at SenseFinancial.com/IRA-makeover. It's a good book. If you do want to book a consultation with me, I'm happy to talk. This is educational. There's no hard sales. If you want to become a client, great. If not, that's cool too. But definitely, if you have something to talk about or you want to run something by, just jump on my calendar. I'm happy to have a conversation. So it's SenseFinancial.com/ actually that URL works, but also SenseFinancial.com/consultation also works. With that, let's take some questions. Looks like we have a few.
Yes, we do. We have a couple of questions today. And of course, if anyone has any additional questions, please don't hesitate to ask. You can use this time to type them up in our Q&A tab. So for the first question, it is from Lincoln. I'd like to know a bit more about the custodian company and how much I would interact with them versus your firm.
Yeah, great question. Lincoln, I'm going to assume you're talking about the custodian that we use for our self-directed IRAs and not a self-directed IRA where you have to go through the custodian for all transactions. That's what I'm going to assume. So when you have checkbook control with an IRA, it doesn't matter who the custodian is, the role is going to be the same. So they are involved in a few different ways. One, obviously the creation of the plan. Two, the transfer in or rollovers of existing retirement funds have to go through the custodian. 3, the annual valuation of 5498 still has to be filed. Because you have checkbook control, you will provide that value to the custodian so they can issue the 5498. And then the 4th reason would be if you do, actually 4 and 5, if you do any Roth conversions, go through the custodian, and then any distributions would also go through the custodian. So there's really 5 reasons why you would have to interact with the custodian. So outside of those, we would be your go-to for any client support that you would need. And we do offer unlimited client support. Additionally, for both the IRA, LLC, and the solo 401k, we do have a client portal that our clients can log into, and there's a knowledge base in there with answers to just about any question you might come up with. But we are here, phone call, text, email away, to help as well. So go ahead. Sorry, Leah.
No worries. The second question is also from Lincoln. Will I need to pay filing fees related to the LLC, and where will it be registered?
Great questions. So our establishment fee includes the first year for everything. Okay. So the easy answer on where is it's up to you. Okay. If you live in a state like California where the annual fee that you're responsible for is $800, you're probably not going to establish it in California. You might. It really depends on the value of the account and your preference and where it's going to engage in business. If you said, I'm going to definitely buy rental real estate in California, the ideal scenario is that the LLC is filed in California, but it doesn't have to be like that. A lot of our clients do Arizona because it's a $0 annual filing or annual fee rather. They do have a filing fee. So our establishment fee gets you everything, including that filing fee. Okay. If there's a registered agent fee, which there would be if you don't have an address in the state where we're filing the LLC or establishing it, then the first year registered agent fee is also covered by us. And then you're responsible for all the fees past that for the state that the LLC is past that first year that the LLC is established in. So hopefully that answers your question.
Right. And the next question is from Abdullah. He asks, can we have the 1-500 credit applied retroactively?
Yes. Yes, you can. It has to be added to the plan within, I think it's 90 days prior to the plan year end, but not it's no sooner than 90, but not later than 30. So it's between like this 60-day period. So if your plan year ends on December 31st, which most do, then we can apply that credit for the following year, but we can't actually apply it until October 1st and no later than the last day in November. It's really weird. So if you came to us today and said, I want this $1,500 credit, we could do that, but we wouldn't be able to do anything with it for 2025. The first effective year would be 2026. But yes, you can do that. If you already have a solo 401k and you haven't taken advantage of this credit, then it can be applied. That is correct. I think we missed one before that from Jax.
Yes, we did. From Jax, can you talk about the process on how you can pull out funds from the solo 401k for someone who's over 59?
Sure, yeah, 59 and a half. So the beautiful part of the solo 401k, remember when I said you are the plan administrator, is that you are the plan administrator. So there's no one to go through on stuff like this. You can ask us for help. We're happy to help. We have all the tools, all the documents, all the forms you need to take a distribution and you fill out a form called a distribution form, and you'll check the box at where the funds are coming from and the dollar amount. And then you will need a 1099 issued to you if it's a traditional pre-tax distribution. Because that's going to be taxed in that year you take the distribution. So we can create the 1099 for you if you ask us to. And then, but you have all the tools at your disposal inside of our client portal to be able to do that distribution yourself. So logistically, you decide, okay, I want to take a $20,000 distribution. Log into our client portal, download the form. It's a fillable PDF. You don't have to print it out if you don't want to. Fill it out. It's for you to keep. You don't need to give that to us. You don't need to turn it into your CPA. Nobody. At the beginning of the year, we're going to send out an email and we're going to say, hey, actually, not even at the beginning, in like December, early December, we're going to send out an email saying, hey, if you need any 1099s issued, make sure you get that to us. We want to finish all of our 1099s by the 10th of January. So it's important to be timely with that, but I digress. So you fill out this form, and once you fill out that form, you quite literally take money from the Solo 401k checking account and put it into your own checking account. So if it's $20,000 you want to do a distribution, then you can wire $20,000 to yourself. You can write a $20,000 check to yourself. You could probably even do an online bill pay of some sort if you wanted to. But yeah, you just have to logistically fill out the form and take that proper money from the 401k checking account and give it to yourself. And then just make sure you get that 1099 request to us or to your CPA or do it yourself for that tax year.
All right, thank you, Brad. The next question is from Joseph. Hi, Brad. Is 30% down payment the lowest we can do with a solo 401k?
Yeah, I mean, it's not, Joseph, a rule set by anybody. It's more a standard. It's a higher risk loan for the lender because you're not personally guaranteeing it. And it's an investment property. And it's a loan to an entity, not a person. And the property is the only security for the loan. And so they do require more down because they want just the loan to value to be a little bit lower on that. And so it's not like a rule or a law. It's just kind of the standard. And as interest rates have increased over the last year or two, yeah, it's more like 40 to 50% now, most of the time. But it depends on the loan program because there's adjustable rates, fixed rates, 20 years, 15 years, 30 years. There's all kinds of different options. So I would check out our website, SenseFinancial.com / non-recourse loans to look at all those different options.
Next one is also from Joseph. Can you flip one or two properties in your solo 401k in order to make the funds grow faster?
Yeah, Joseph, thank you. Good questions. You can, yeah. The general rule is a couple flips. Okay, so I didn't talk about this. UBIT tax, UBIT, unrelated business income tax, comes into play in a solo 401k and an IRA. In the IRA, two ways: leveraged real estate, like I talked about, and then in the 401k and the IRA, another way, and that is if you're running a business inside the retirement account. So the IRS, to level the playing field between you and somebody else running a business having to pay all the taxes that they would normally pay, said, hey, it's not fair for Brett to own a dry cleaners inside of his IRA and not pay any taxes, while Mr. and Mrs. Smith down the street own the dry cleaner personally or in their corporation, and they have to pay all kinds of taxes. So to level the playing field, they have UBIT tax on that income. Now, a dry cleaner is like kind of a weird example, but you could run and own an active business. Now, when I say run, again, remember, blue collar, bad, white collar, okay. So you can't work in that business. You can't do anything. You can like manage the manager, so to speak, but you can't go there and like show them how to iron a shirt. Can't do that. You can't physically do any work or provide services. Okay, you could hire the manager, but you should stay away from hiring and firing employees. Like that's not something that you should do. So anyway, I digress. The reason I bring this up is because there is a way to do a certain amount of flips per year and fly under the radar of the IRS saying you're running an active business, because fixing and flipping real estate is not a passive activity by any stretch. And by the way, remember, if you're flipping inside your retirement account, you can't do any of the work. It all has to be third party. You, your spouse, your children, their spouses, your parents, your grandparents, none of those people can do any work on the property. If you own a contracting company or a handyman business, your contracting company cannot do any work on that property. You and everything you own is a disqualified party. So it all has to be arm's length. So with that qualifier, you can probably do 1 to 2 a year and not trigger a UBIT tax on the income. It's a gray area, but that's pretty much the precedent that's been set. Now, the other factor is if you go above 1 or 2, the other factor is what is the nature of the retirement account besides flipping real estate? If it's primarily doing private lending, which is a passive activity, and then you flip 1 or 2 a year, you're definitely going to be okay. If it's primarily a hard money lender and you're flipping 3 or 4, you're still probably going to be okay. The reason I say probably is because it's kind of like risk tolerance to you. But generally speaking, people get away with it, definitely at 1 or 2, and almost definitely if the primary nature of the plan is a passive activity and you kind of push the envelope on a few more flips. And it doesn't mean that it doesn't make sense to do fix and flips inside their 401k or IRA and still pay that UBIT tax. I mean, if it still can make sense. I mean, you're paying the tax and it scales up to 37% at 12,500 of income for the year. So it can be pretty hefty, but you do get to subtract expenses and depreciation if it's long-term holds and such on that portion that is subject to the UBIT. So it's not just like a straight up dollar for dollar to get to 12,500. It's a little more complicated than that. But anyway, I know I went off on a tangent on that, but hopefully that helps, Joseph. I appreciate the question.
The next question is from Domini. What if I rep up my sole prop? Is it still possible to keep the solo 401k active?
Well, you have to have self-employment activity. We can change the sponsoring business, either the name of the business or the entity. You know, if you go from sole prop to S corp, we can change that. If you change the name, it doesn't matter. We can amend the plan. There's no cost for doing that if that happens, and you can maintain that plan. But you still have to have that legitimate self-employment activity. So if you are no longer self-employed, then we need to have a conversation. You either need to roll it over into an IRA or we need to terminate the plan. Either way, the plan probably needs to be terminated unless you're going to get self-employment activity in the not too distant future. The IRS is pretty flexible in this. It's not like, you know, if you're not self-employed today, tomorrow they're going to come knocking and say, you know, the whole 401k is a distribution. That doesn't happen. They actually give you like a lot of flexibility. It's up to about 3 years to terminate the plan or roll it into an IRA once you're no longer self-employed. But the plan is essentially frozen at that point. You can't make any more contributions. You can only manage the money that's already in the plan and invest it. So there's your answer.
All right. The next question is from Shane. My brother in law is planning on lending me money out of his self IRA as a personal loan. Then I will use that money to buy a property he has had his eye on. Are there any loopholes or regulations that we need to be on the lookout for? The managing partner will be him, my brother in law, but the money would look like it's coming from an outside lender. Hope this makes sense.
I mean, your brother-in-law is not a disqualified party. So yeah, that would work. I don't understand maybe why you would do something as complicated as this or as risky as this, in the sense of like you're using the IRA to buy the property, but your brother's had the IRA. No, I'm sorry. Yeah. No, the brother. Okay, so hold on. Sorry. The brother-in-law has an IRA. He's going to do a personal loan to you. Then you're going to use the money to buy a property that he's had his eye on. I don't understand that. Why would you do something like that? He should just buy the property. If he's going to benefit from that, he can't benefit from that in any way. He can't make money on it other than the loan payments back for that loan. He can't go stay at the property. I don't understand that. So you can type more in there, but I would probably caution you against doing something like that. I guess I don't understand the why. Maybe that's why I'm answering that way. So
Next question is from Delise. I have a solo 401k. I would like to change it to a Roth. Does it need to be done in the year it's changed, or can it be done up to the April 15th for the previous year?
the Roth conversions are done in the year. They're taxed in the year they're done in. So if you did a Roth conversion on December 31st, that would be taxed in 2024. If you did a Roth conversion on January 1st, 2025, that would be taxed in the year 2025. There's no retroactive Roth conversions.
Next one is from Demini. Is the solo 401k process the same if it is sole prop versus LLC S Corp, or is it different because W-2 income?
Well, the process setup wise is the same. It's the contributions that are going to be different. So I didn't dig into this. So I'm glad you asked the question. Lots of questions today, Leah. I like it. The contributions to the 401k are based on the W-2 income if you're a sole proprietor. So I did say that. So the amount you pay yourself on a W-2 is going to dictate the contribution limits, right? So again, 23.5 employee, 20, and then 25% of the W-2 on top of that. But you have to pay yourself to make those contributions. No W-2, no contributions. Okay, so that's logistically the difference. The sole proprietor, and because they have to be done through payroll as an S Corp or C Corp, you have to generally, they have to be on the W-2 for that year. So you can't go past the year and still make an employee contribution, right? So if it's January 5th, there's some gymnastics that a CPA or payroll company can do to still put money on a W-2, even though the year is over. But generally speaking, it's easiest to just pay yourself on the last day of the year at the latest and make a contribution on the employee side of things. Again, the employer profit sharing is still based on the total W-2 for the year. So if you only pay yourself $20,000 of W-2 income, you're not going to come close to maxing out the total limit on contributions. You can get close to maxing out the employee contribution because that's not a percentage. It's like dollar for dollar, but you have to factor in FICA and Medicare. So if you're going to max out the 23.5, you're probably going to have to pay yourself a minimum W-2 of like 25 or so. Check with your CPA on that. But again, the profit sharing is only going to be 25% of that total W-2. So hopefully that makes sense. On the sole prop side, it's 20% of the profit of the company. So you subtract your expenses to run the business, whatever's left over, 20%. On the employee contribution, it's same as the W-2, but there is no W-2. You could just, out of that profit, you can contribute up to $23,500, and then the rest can be the 20% of the profit, not to exceed 70,000 for both of those examples. So hopefully that answers your question, Demini. Sorry.
The next question is from Delise. Is this $1,500 new? I was not aware of it when I set it up 13 years ago.
Yeah, it's been out for about 18 months, maybe something like that. I'm not exactly sure of the inception date, but it definitely was not around 13 years ago. It's part of Secure 2.0, which came about 2020, I think. Don't quote me on that, but it definitely was not around 13 years ago.
Next one is also from Delise. In a solo 401k, does the checking account need to be a business account?
It's not a business account.
All right. The next question is from V. If my solo 401k plan is already set up in CA, can I move it to a less expensive state even if I live in CA? Also, if my investments will primarily be private trust deeds on properties located in CA, can I still move the plan to Arizona, AZ?
Yeah, good question. So the solo 401k is a trust structure. So a trust is not registered with any government entity. It's a private document. So um, the it's irrelevant. Your question is irrelevant. You can live anywhere and invest anywhere, and it's fine. Now, if you're talking about the LLC, um, same story. It's just a holding LLC, right? You're not conducting business in it where there's going to be like a business tax return necessarily. Um, so if your LLC is filed in California, you could still hold Arizona real estate inside that LLC. There's nothing stopping you from doing that. Um, you're probably going to get a third party manager anyway, but I think the one exception would be is if you were going to foreclose on, excuse me, well, foreclose or do an eviction, I guess. But either way, you're gonna third party those out. If you have a property management company, they're gonna handle that themselves. You don't have to have the LLC established in the state that the property is in. Now, I'm not an asset protection attorney, so feel free to double check that. But the solo 401k for sure, that's an irrelevant question unless we added another kind of special purpose LLC on top of the solo 401k trust that's already by default part of the plan, which is pretty rare, but it's you could do it.
Thank you, Brad. This question is from Delise. My year end is June and I have a solo 401k. I would like to change it to a Roth. Does it need to be done in the year Oh, sorry. I think this one we've already covered.
It's just asked in a different way. So yeah, we did.
Right, then the last question for today is if a plan is to be frozen, can I still take a loan from it if needed? This one is from Demini.
Gotcha. I am going to say this is the first time I have had that question. I love it. My clients teach me so much, even prospective clients. So thank you. Um, I I don't know the answer to that. I will get back to you on that. I think typically when it's frozen, let's see, has been frozen. I'm reading something on Google real quick. The first. Whoever the house is. Hmm. Yeah, this is unclear. Yeah, it's unclear. I'll shoot you an email, Domini, with the answer to that. That's a great question. Thank you for it.
All right. Those were all of the questions that we have today. Brad, would you like to add anything before we conclude, perhaps about the upcoming changes in
Yes,
February?
yes. Thank you. So we have two fees for all of our plans. Okay, so we have an establishment fee and an annual fee. Now, our annual fees for all plans is a flat $250. Okay, our establishment fee for the IRA LLC is $2,000. Our establishment fee for the solo 401k is $600. So those establishment fees include the first year annual maintenance fee or custodial fee of $250. So that 250 doesn't start until year number 2. The reason I'm bringing this up is because the solo 401k is increasing from 600 to 800 on February 1st. So if you are interested in doing this, it's a couple $100. It's not that big a deal, but I'm just letting everybody know it's going up a couple $100. So if you want to do this and you want to save a couple $100, let's talk before February 1st. So thank you for the reminder on that, Miss Leah. I appreciate it.
Thank
Otherwise, you
you.
can contact us at 949-228-9394 or contact at SenseFinancial.com. And again, my calendar is SenseFinancial.com/consultation. Thank you very much, everybody.
Thank you, everyone, for joining. It was really great to have you all. Please reach out to us if you'd like to learn more about self directed retirement accounts or if you had any additional questions. Have a great day.